Working capital and capital employed. In this lesson, we will look at working capital and capital employed, two key balance sheet concepts, how they are defined and what they represent. Working capital concerns the assets and liabilities involved in the firm's short-term trading operations, while capital employed concerns the firm's long-term investments and the stable long-term financing of the firm from lenders and the firm's owners. We will look at the current ratio, a key financing metric which shows whether a firm's working capital is a source of financing for a firm's non-current assets or requires funding from its non-current liabilities and equity. We'll look at the concept of capital employed and how this can be defined and looked at from operating and financing perspectives. Finally, we will look at an alternative presentation form for the statement of financial position to the vertical presentation form introduced in the first lesson. Session aims. In this session, you will learn about two key balance sheet concepts. First is working capital, which concerns the firm's trading assets and liabilities, and the second is capital employed, the firm's operating assets. And these are assets that have to be funded with long-term financing. And as usual, the intended learning outcomes for this lesson. Working capital. Working capital is a key and frequently misunderstood business concept. Working capital is concerned with the short-term trading operations of a company and is defined with a time horizon of up to 12 months. This 12-month time horizon is dictated by IFRS and other accounting standards and is considerably longer than the operating cycle time of most firms. On one side of the statement of financial position, we have current assets, the amounts that customers owe recorded in accounts receivable, inventory, and cash equivalents. On the other side, we have current liabilities, the amount a firm owes its suppliers recorded in accounts payable, its short-term borrowings, and any other short-term liabilities. Part of these current assets are funded by the current liabilities and hence do not need to be funded with long-term borrowing or owner's equity. Working capital is defined as the difference between current assets and current liabilities. So working capital equals current assets minus current liabilities. Spend a minute looking at the key components of working capital. We'll start on the asset side. So there's really three items which are key. Cash and cash equivalents. These are money held with banks and in short-dated money market instruments such as commercial paper. Accounts receivable, which is used to record amounts owed from customers for goods and services that the firm has sold but have not yet been paid for. And finally, inventory or stock, raw materials, work in progress and finished goods. And then on the liabilities side, the most important of the liabilities is accounts payable. This is used to record the amounts which are owed to suppliers for goods and services which have been delivered to the firm but have not yet been paid for. A smaller amount may be recorded under bank overdrafts, short-term borrowings from financial institutions. Net current assets and net current liabilities. There is no reason why current assets should always be greater than current liabilities, and hence the value for working capital may be either positive or negative. When positive, working capital represents the portion of current assets which must be funded by long-term financing. Working capital can also be referred to as net current assets when this is the case. When negative, it represents the portion of current liabilities that are available to fund a firm's non-current assets. In this situation, working capital is usually referred to as net current liabilities. Retailers, such as Morrison in the UK, operating in sectors where firms sell goods to customers for cash, where the stock is turned over quickly and they pay their suppliers very slowly, usually have net current liabilities. Manufacturers, which tend to have slow-moving inventory and to sell their goods to customers on credit, often have net current assets. It's driven by the nature of the business relationship with customers and suppliers and inventory characteristics. And here's an example of Morrison's working capital. So cash and cash equivalents, 326 million. Accounts receivable, relatively small number, 137 million. inventory much larger, 614 million, other current assets 99, total current assets is 1176. Dwarfed by their current liabilities. So accounts payable 2837. This is the amount that Morrison owes its suppliers at the end of 2017, considerably larger than the value of the stock that it holds. So working capital, net current liabilities of £1,688,000,000, and that is available to fund its non-current assets. This is a source of free financing, so it's much more attractive than relatively expensive long-term financing from an investor. The current ratio is a key financing metric which shows the ratio of current assets to current liabilities. So current ratio equals current assets divided by current liabilities. When the current ratio is greater than 1, it means that a firm's current assets are greater than its current liabilities, so it has net current assets. In this case, it shows the number of times that current assets exceeds current liabilities, and that excess will need to be funded from non-current liabilities and equity. When less than 1, a firm has greater current liabilities than its current assets, so it has net current liabilities. In this case, the current ratio shows the proportion of current liabilities being used to fund current assets, and the balance that's left over is available to fund non-current assets. Take the case of Morrison at the end of 2017, current assets of 1176, current liabilities 2864, current ratio of 0.41. To put this into context, at the same time, the most recent values for Sainsbury's was 0.66, for US retailing giant Walmart 0.74, and for French retailer Carrefour 0.78. So current ratios less than 1 are typical of large retailers with a powerful relationship with their suppliers who turn their inventory over quickly and have cash sales largely from their customers. Let's move on to capital employed. So capital employed is looking at it from a long-term perspective. We can look at we can look at this in two different ways. We can look at it first of all from an operating perspective. So if we look at it from the operating perspective, the operating assets of a firm are comprised of its non-current assets, its fixed assets, its property, its plant, its equipment, its investments in associates, its joint ventures, and also its working capital is relatively stable over time and requires funding. If it's net current assets, it requires funding. So we can define capital employed as non-current assets plus working capital. And of course, this has to be financed. And this is financed with a mix of non-current liabilities, so bank loans, bonds issued, and owner's equity. And mathematically, because of the accounting equation, of course, these two must balance. So we can define capital employed as non-current assets plus working capital, or as non-current liabilities plus equity, and these must be equal. And here's an example of Morrison's capital employed. So Morrison's non-current assets of £8,070,000,000, net current liabilities of 1688. So its total capital employed is 6,382,000,000, and this is financed with non-current liabilities of £2,319,000,000 and owner's equity of £4,063,000,000. Let's just take an aside and talk about financial leverage. Throughout business, you will come across examples of gearing or leverage. Gearing produces higher returns, but at the expense of firms operating closer to their break-even point and hence being at greater financial risk. On the balance sheet, gearing arises when companies choose to finance their operating assets with debt and equity rather than equity alone. The higher the amount of debt, for our purposes defined as non-current liabilities, the higher a firm's financial leverage. So many ways in which firms can have gearing. Gearing leverages operating returns, means firms are operating close to break-even point. Higher gearing can produce higher returns, but at the expense of higher risk. Financial leverage concerns the proportion of long-term financing that comes from debt. The more debt, the higher the financial leverage. And the two metrics which are commonly used are the debt-equity ratio. You'll see this often referred to in newspapers such as Financial Times, This is the ratio of non-current liabilities to equity, and also the financial leverage ratio, which is defined as capital employed divided by equity. The proportion is looking at how much of the capital employed is funded from equity. But of course, we can define capital employed as equity plus non-current liabilities. So this is also equal to equity plus non-current liabilities divided by equity. These two are different ways of illustrating the same underlying leverage relationship. And if we look at Morrison's is actually a relatively ungeared firm. Non-current liabilities of 2,319,000,000, owner's equity of 4,063. So its debt equity ratio is less than 1, is 0.57, and financial leverage multiplier is +1, so 1.57. IFRS does not dictate what form firms should report the statement of financial position. We looked at the vertical presentation form in the first lesson. I'm going to look at the net asset presentation form. This form is particularly popular amongst UK companies and in countries which have been associated historically with the UK. And this starts off from the equivalence of net assets is equal to total assets minus total liabilities, and from the accounting equation this equals equity. Common form in the UK, and in fact it's used by Morrison when they report their balance sheet rather than vertical form I've illustrated. I've restated their balance sheet. So what does it actually report? So this is what if you go to their annual report and look at their financial statements, this is what you will see. So non-current assets followed by current assets, UK firm, and then current liabilities represented as negative numbers. This doesn't actually make sense in that if I owe a bank money, I don't talk about having negative amount. Nevertheless, the liabilities are presented as negative numbers. Subtracted from the assets gives net assets of 2017 of 4,063,000,000, funded with owner's equity of 4,063,000,000. One of the first things I would do if I came across a balance sheet in this form is to restate it into the vertical presentation form, which is much simpler and makes much more intuitive sense and is easier to deal with. In this lesson, we've looked at what working capital is and its major components, the use of the current ratio as a measure of financing relationship between working capital and non-current assets and non-current liabilities and equity, what capital employed is and its two perspectives, operating perspective and financing perspective, and we've introduced the idea of gearing and financial leverage, in this instance looking at the relationship between debt and equity, and this is something we will revisit. And finally, the net asset presentation form for the statement of financial position.